If you're a software founder executive, the most important question you're probably asking yourself daily is how can I maximize the value of my SaaS business? I'm Paxton Earl with Software Equity Group, and in this report, we'll be showing you exactly what's happening in today's SaaS market, the difference between having a 5x and 10x SaaS business, and how you can position your business to be as valuable and attractive to buyers as possible. As a SaaS founder executive, one of the most important metrics to understand is your enterprise value to revenue multiple. And looking at these SaaS revenue multiples today for M&A deals, there's one key dynamic that's worth noting. It's the widening spread between the median and average. And looking at these multiples, the median multiple since 2022 has stayed relatively tight, hovering around 4x. However, the average has now ticked up from 2023 to 2024 and now 2024 to 2025, increasing over 13% just since last year. And what this means is that the M&A market from a valuation perspective is barbell shaped. There's on one end a large number of deals that are lower value deals happening at lower multiples, either at 4x or closely hovered around it. At the same time, there's still a significant number of high value deals that are trading at premium multiples, 7x, 10x, 15x, 20x or higher, that are dragging up the average. And so you might be naturally asking yourself as a founder, well, how can I take my business from a 4x at the median multiple to average and a premium multiple? And there's a few key quantitative metrics and qualitative metrics that can take you from these 4x multiples to premium multiples of 10x or higher. And to answer this, we should first look at the underlying business metrics of SaaS businesses within the SaaS index. Looking at the median metrics of all of the companies in the SEG SaaS index, there's a few things to point out. One, total revenue and total EBITDA are at their highest points ever. Profitability margins, EBITDA margins, and gross profit margins, companies are more profitable and generating more dollar values of revenue than ever before. However, market capitalization is down and revenue multiples are down over the last 4 years. And so while business performance is at its all-time highs, but valuations are not, for founders, this creates an important question and takeaway, and it's that valuation outcomes are being driven by more than just growth and margins, more than just business operating perspectives. And that benchmarking your business and understanding its value isn't purely just about understanding operating metrics and percentages. You also need to understand how the market is qualitatively assessing value, durability, and risk, and how investors are pricing these in. And to understand why this disconnect is existing right now between strong business performance but a differing valuation, we need to look and understand what's happening in the public markets and the public SaaS markets and their stock prices. When you look at public SaaS performance and valuation, the key point is that SaaS businesses are operating stronger, more efficient, and are becoming larger than ever before. Gross margins, revenue, they're the best they've ever been. However, valuations have clearly not followed the same trend. The SEG SaaS index has underperformed major indices like the Dow Jones and S&P 500 and the NASDAQ. And AI is at the center of that shift. AI represents a true paradigm for application and enterprise software, and it's forcing investors to rethink how they price competitive moats and displacement risk and where true durability and customer value exists in B2B SaaS. And within that, where we can look at this AI dynamic is the upper quartile. The upper quartile of the SEG SaaS index actually did pretty well. It was positive 6% in all of 2025. However, it's being dragged down by the lower quartile and the broader SaaS index. And kind of what's going on in there is that the upper quartile contains companies that are taking advantage and are leveraging this AI paradigm shift as a moment of strength for them. It includes companies like Snowflake, Cloudflare, MongoDB, and which are product categories like analytics and data management, DevOps and IT management, and security. And so these businesses are being rewarded by investors because regardless of this AI shift, they're actually being strengthened by it. So for SaaS founders, it creates a dynamic where in order to make your business stronger and prove to investors that you can persist through this paradigm shift, you need to have a business that's enhanced and leveraged and has more intelligence through data. And through that, your customers rely on it and it's hard to rip out. And so, the more data and the more workflows and the more intelligence that you can build into your software platform, which ultimately makes it the harder to rip out, more durable, and really strong retention, the stronger your business will be. And the interesting thing about this is that private markets typically lag public markets by 6 to 9 months. So if these types of businesses qualitatively, these types of AI profiles are being valued in the public markets, it's only a matter of time in a couple months before these qualitative metrics are now even more valued in private markets and M&A. Going off that AI narrative, while the public markets, it's largely prevalent that the AI centered businesses are being valued by investors, it's starting to trickle down and have a strong showing in M&A. What this chart is showing is just the number of targets every year that are being acquired that have an AI related word in their business description. And so it's just further evidence that AI is becoming a central theme for investors and how they're valuing SaaS businesses. And the AI dynamic is forcing investors to ask SaaS founders these two main questions. Is your SaaS business at risk for being displaced by AI, and how much? And if it is, how are you mitigating this risk, and or are you leveraging this as an opportunity to adapt your business and make it modern in the AI landscape and even more intelligent and efficient? And so the public markets are always ahead of the private markets. And since we're already seeing this valuation divergence and difference in the public markets, this chart is now evidence that it's starting to trickle down into private markets and M&A, and that data ownership, mission criticality, and critical workflows will increasingly shape the private market M&A. And if we're just seeing a 800 deal increase just from 2024 to 2025, it's likely only going to increase over the next few years. For founders, this is a moment to step back and ask where your business sits today, where it sits tomorrow, and whether AI is a threat and whether you need to mitigate that, or it's an opportunity that you can use to leverage and strengthen your business, have it adapt and move closer to these premium valuation outcomes. Aside from just AI deal count, when you look at SaaS M&A more broadly, this year was the highest volume deal year we ever saw, and there's a few factors that are really driving this. One, there's more SaaS companies than ever, meaning for founders, there's more competition and more volume of SaaS companies than ever before. And companies are taking advantage of this. They want to position themselves in this technological paradigm shift right now aggressively and as fast as possible. So while there's more SaaS companies than ever before, and that AI is now driving this, it's making investors aggressive. They want to place their stakes in AI right now. A lot of this deal volume is from a strategic lens. Over 93% of these deals involve a strategic angle, regardless of backing status. And while new platform investments make up a smaller portion of acquisitions, it just shows that how investors are looking at these targets. They want a strategic angle. They want to buy companies that are product add-ons that expand data, workflows, automations, intelligence. And so for founders, it's to answer those requests from buyers. How valuable is your data? How critical are your workflows? How much intelligence automation is built into your platform? And can you be a part of a larger organization to automate themselves, make them more efficient, and not just be a standalone platform investment, because it's ultimately making up a smaller portion of these deals and acquisitions. The biggest takeaways for SaaS founders and executives is one, the valuation market right now is barbell shaped, and only a few variables determine what side of that barbell you land on, whether it's going to be a business earning a median multiple of 4x or a premium multiple of 7x, 10x, or higher. Growth, retention, durability, and how embedded your product are by far the most important metrics and traits to track. If you're break-even profitability but have impressive growth, strong retention, that then means you have strong durability and your product is going to be incredibly critical to your customers. That's the most valuable thing to focus on. At the same time, qualitatively, AI is the dominant force shaping valuations and largely M&A volume right now. It's driving the highest volumes we've ever seen, and it's forcing buyers to be as aggressive and strategic as possible right now. We're in the middle of a paradigm technology shift, and founders who don't at least have an AI mitigation strategy, or ideally a clear roadmap that will prevent them from being penalized by investors by them saying, hey, you don't have a strategy for this AI shift, we can't give you a premium valuation. On the other hand, if founders do have a way to mitigate this and ideally a clear roadmap that shows that they're leveraging this to make their business adapt and make it stronger than ever, these are the founders that will position their businesses to benefit from AI rather than being displaced and penalized by investors. And they will be the ones that are earning the premium valuation outcomes in SaaS M&A deals in the future from 2025, 2026, and beyond. And these will be the strongest SaaS businesses we've ever seen. This is what SaaS founders need to know today. If you have any questions, be sure to follow Software Equity Group on LinkedIn, as well as myself, Paxton Earl, and my colleague, Austin Hammer. Thank you.